and we're going on to our next presentation, which is Trident Royalties. Now, it is a diversified mining royalty company, and it's growing quickly. It's dual listed. It's on AIM. The market cap currently is £109 million or thereabouts. I'm delighted to be joined by the Chief Executive, Adam Davidson. Good to see you again, Adam.
Hi, good afternoon. Let's see, I'm just sharing my screen now. Hopefully everybody can see that. Standard disclaimer, and I should flag that this is the same presentation effectively that's on our website. And in fact, we've got a little bit more content on our website, but did a slightly abbreviated version for this presentation. As you said, Trident Royalties, so we're a mining royalty company. I'll explain what that is exactly in a moment. But the quick background on the companies, we listed on AIM in mid-2020. At that time, we listed at 20p a share. We're kind of hovering around 35 at the moment. We listed with one single royalty. We've now got 21 assets, a total of 13 of which are cash flowing across a broad spectrum of commodities with a heavy bent towards EV battery metals exposure. So the quick background on what exactly is a mining royalty, it's not dissimilar from royalties in other sectors. Most people are more familiar with music royalties or movie royalties. And in those situations, obviously the artist is paid when they sell an album or when a movie is played. In the case of a mining royalty, it's not hugely dissimilar. We effectively are financial instruments, and they entitle us as the royalty holder to a cut of revenue from the underlying operation. So they typically range anywhere from a 0.5% to 2%, but they can really be any number. And effectively, the type of exposure that they offer is slightly different from mining equities, or in fact investing directly in the metals themselves. The biggest thing is because we're getting top line exposure. So when an operation sells the material, generates revenue, we get a percentage of that revenue. Whereas equity exposure, obviously you're getting bottom line exposure, where you have to have the operation in profit for equity to be making a return there. A royalty is different in that we get a cut of the top line. It's much more stable in many respects. All things being equal, if production's equal, you're effectively just directly exposed to the commodity price rather than exposed to operating costs and capital costs of the underlying operation itself. And then relative to physical commodity ETFs, there are other instruments that will give you just sort of physical metal exposure. The reason people invest in mining equities is because I think it's 80+% of all mines that are built extend their life or expand their planned production profile. That's the reason people invest in mining companies. You want that asset level upside exposure. So we kind of get the best of both worlds. From a protected instrument that's not exposed directly to operating costs of the mine, we get that asset level exposure. But then we're also hedged such that we're getting primarily the metal price exposure, and doing so via an instrument that in most cases survives bankruptcy. Once it's pegged on the land, it's on that property in perpetuity. In most cases, it can't be diluted. Importantly, so whereas many miners have to raise equity to fund expansions or to build their project. If a royalty is on a property, it's that number, and it's there forever. So a very attractive instrument and a good way to get exposure to the mining sector. Taking a brief look at our portfolio then, as I said, we built it out from one asset at inception to 21 now. We added a total of 5 assets last year, 4 sort of significant sized ones. 13 of our assets are cash flowing, and importantly, over 60% of our net asset value per analyst consensus estimates is in Canada, US, and Australia. Yeah, we've got some assets further afield in South Africa and Zambia, for example, but we want to keep the bulk of our exposure in developed jurisdictions for a couple of reasons. Obviously, the geopolitical risk angle, but also the legal framework for royalties is usually better. Ensuring that the royalties survive bankruptcy and some of those attractive features that convey with them. The other thing to flag on this slide is we flag them as select royalty partners, but these are the operators of the asset. And often it can be assumed that because we're a junior royalty company, that all of our royalties are over junior-led projects and therefore are sort of higher risk when commodity prices move through the cycles up and down. When in fact it's almost the exact opposite that's true. The bulk of our royalties are operated by mid tiers, or in a couple cases majors, and we do have some juniors as well. But the likes of Lithium Americas, a couple billion market cap, Equinox Gold, similar Mineral Resources, 8 billion market cap. So good, strong operators with strong balance sheets. The bulk of our royalties were acquired from third parties that have these royalties on their properties, predating these mid tiers taking acquisition of the property. So in most cases, we're not providing finance to these operators. We're buying them from third parties that have held legacy royalties over the properties. And you'd be amazed how many of these things there are. That there's literally thousands of royalties out there in the world. So sifting through them, finding the ones that have meaningful value and near-term cash flow, and then acquiring them on an accretive basis is really the bread and butter of our day-to-day business. You can see our revenue profile here. This is again per consensus estimates. I like to flag here that the sort of gold part of the bar is assets that are currently in production. And so we see a step up in revenue over time as assets are a couple are in ramp up, so they're increasing their production profile as they approach steady state. And then the light blue is predominantly driven by assets that are currently in construction or have very near-term revenue. I'll talk to one of our assets, Thacker Pass, in a moment. The major lithium asset, it's in construction. The operator spent nearly $100 million in construction just last quarter. So I guess really what we're trying to underscore here is that many companies show a revenue growth profile that has sort of a hockey stick characteristic to it. But on ours, we believe that it's very tangible and that it's largely driven by assets that are either producing today or are in construction today. And on to kind of the EV style exposure that we're providing via royalties. You can see the commodity breakdown of the portfolio as we stand today. When we first listed, we just had a single iron ore royalty. It now makes up less than 2% of our NAV. The bulk of our net asset value is in lithium and spread across a few assets there, followed by 30% in gold and then 20% in copper, and then silver and then a smattering of other commodities. I think one of the competitive angles of Trident is the mining royalty sector is not tiny. It's in aggregate about 70 billion in aggregate market cap, and yet only a very tiny portion of that, a couple billion, is focused on non-precious metals. The bulk of our peers are focused on gold royalties, and effectively they're a gold derivative trading instrument for many investors. And that's a nice exposure to have, but it leaves open a big chunk of the mining sector. A full 2/3 of the mining sector is not precious focused. It's base metals, increasingly battery minerals, and that's really the area we're focusing on. We will do gold royalties when we can find value, when we're not competing with the 20-odd gold royalty companies. And incidentally, we've found a few more than we probably expected. Hence why our gold exposure is 30%. That's largely driven by one larger transaction. I think as time progresses, we'll see that gold exposure start to whittle down a little bit as we add more base and battery metals. Just looking for a second at lithium. This is a commodity that we're very pleased to have gotten good exposure to. You can see on the left side a couple of the charts. You see this exponential growth in the uptake in EVs and hybrids. And I'm sure you all have heard some of the aggressive targets out there. I think 50% EVs and hybrids is the current U.S. administration's target by 2030. California has a mandate for 100% by 2035. I think we all anticipate these targets will move around, they'll flip, all those sorts of things. But I think the general trend is pretty undeniable. I don't expect that these numbers flatline from 2023 in perpetuity. I think we continue to expect to see that level of growth. And I guess the reason we like lithium so much as a cornerstone of our portfolio is when you look at the lower charts of the battery chemistry of all types of the key batteries being used in EVs, lithium is a core component. There are battery designs that have engineered out nickel. Others have engineered out cobalt or are reducing it given its scarcity. Some don't use manganese, but they all effectively use lithium. So it's a commodity we very much like having exposure to. And then the next natural question is how do we have exposure? So I'll talk to Thacker Pass. Just given the shortness of time, I'll only talk to this asset, but again, I point you to our website. We've got loads of material on all of our assets. But Thacker Pass is our biggest asset on a NAV basis. Depends on the analyst lithium price assumptions, but probably around 25% of our total value. It truly is a tier one asset in a tier one jurisdiction. It's in Nevada, in the U.S. The U.S. effectively doesn't produce much domestic lithium at all. It's all imported. It's flagged as a critical mineral. Particularly in this macro environment, there's a real push for security of supply. Both of the recent administrations have been supportive of this project, both the Trump and Biden administrations. And we bought this royalty back in 2020 when the asset was sort of moving towards construction. You fast forward to today, it's now finalized all of its permitting. In the U.S., as you can imagine, permitting is a lengthy, decades-long process. It completed that around this time last year. General Motors has bought in, putting in $650 million, be the largest shareholder of the operator. They'll have all the offtake of stage one production. It's the biggest investment by an automaker directly into the battery metals extraction. It's a globally significant blue chip asset, 40-year mine life with plenty of scope to extend that life or expand production. We picked up the royalty for $28 million in 2021. At $225,000 lithium price, it would pay us about $21 million a year once fully ramped up. At the high lithium price last year, it would have been paying us sort of $70+ million a year. Lithium's got that scope for continued volatility as it's not an exchange traded commodity and it's in this sort of growth period. There will be years of really outsized return over that 40-year life. We were originally pricing in a 16% post-tax IRR. Mid-teens is generally our target. Again, we were using a $12,000 per ton long-term lithium price. That's increased over time to about $21,000 per ton. The planned production profile increased by a third, which again highlights the benefits of royalties. Initially on the pre-feasibility study was a $550 million project. They increased the planned production profile, add in some inflation, and now it's a $2.3 billion project. Now it's being built, so we don't have to worry that won't be financed. But from our perspective, we get just over 1% of their revenue. We get that in perpetuity. We can't be diluted. The cost of the project, that doesn't impact us whatsoever. In fact, the fact that they made it a bigger project is very beneficial for us because that means more production equals more revenue. Just flipping forward to copper, we do have some good copper exposure. It's a commodity that we're very bullish on. We've got one producing copper royalty. It's already paid back the deployed capital that we put into it. And then our most recent acquisition in November was a copper royalty in the U.S. A good project that's on the cusp of releasing its pre-feasibility study. So moving pretty aggressively through that development cycle to get to a construction decision. The final slide here is just to flag our balance sheet. We recently announced a revolving credit facility with a couple of the big commercial Canadian banks, BMO Capital Markets and CIBC. That'll be a $40 million facility, revolving in nature, such that we can draw down on it to make acquisitions and pay it back and draw down and repeat that process over and over. And that's really the way that most of our large gold-focused royalty peers have grown their business. It avoids equity dilution by being able to tack into credit facilities to expand the portfolio. So we're really pleased to get that, and it's much lower cost. Sort of depends on leverage ratios, but kind of 2.5 to 4.5% over SOFR, and we expect to be on the lower end of that range. So well funded with a strong balance sheet, $19 million in cash, most recently reported number, and good institutions, for the UK market, the ones you'd be aware of, the Ruffers, the Maudis, BlackRocks of the world, very supportive shareholder base. So for us, I think we're through the proof of concept phase. We've built out the business over the last few years. And now as we're on the cusp of seeing our revenue really start to tick up and we continue to add new royalties, we think we're at a very exciting period for the business. And with that, happy to pivot to questions.
Many thanks. And that's another very good looking shareholder register, just like the previous presentation made by Equipmake. So yes, there are a few questions. Olin asks, mining royalty, a bit more detail, please, on protecting downside if the mine goes bust.
Yeah, that's a good one. I think a key thing for us, obviously, in our diligence is to make sure that we're getting royalties over defensive assets that will survive the commodity cycle. So in an ideal world, those are assets that are in the lower half of the cost curve, meaning that half the producers are higher cost than they are, such that the price has to dip, and you need to see quite a few operations shutting down because they're uneconomic before the operations that we have royalties over shut down. Yeah, a good example of that, just because I spoke to it, is Thacker Pass in their final study released about 11 months ago. They flagged $6,700 per ton cost of production. So that's a very competitive cost structure. But I suppose the other thing is just the inherent value in royalties themselves. As I said, they do typically survive bankruptcy. Depends on the jurisdiction, the legal framework, but most common law countries, they survive bankruptcy. So there are instances of when an operator either gets into balance sheet troubles and shuts down, or the commodity price dips and the operation is idled. Unlike equity, which may get really dinged or wiped out in those scenarios, the royalty sits there patiently, and there are many examples of royalties turning back on as a new operator takes over or the commodity cycle turns. So it's not 100% protected in that if you get a royalty over an uneconomic mine, that's suboptimal, but it is better protected than equity.
Okay, Paul asks, is uranium now on your interest radar?
It is, and it always has been. I've done a lot of work in a previous life in uranium, as has one of my colleagues. So we've always been on the hunt for good quality uranium exposure. It's something we would like to add to the portfolio. Yeah, as a flag, when we first launched this vehicle 3.5 years ago, we had just that single iron ore royalty, which is now less than 2% of our NAV, and we've been pretty aggressive about building out the portfolio. That's going to be a constant work in progress, and certainly have uranium on the list.
Dividends, how likely are they to be incorporated into the business model?
Yeah, I think we're all conscious that the UK is a very yield-focused market, and this model very much lends itself to being a dividend payer, in the sense that when you look at our biggest peer in the space, they're 25 billion market cap. They've got less than 40 employees. The fact is, we're not operating mines. We've got 6 employees. We're acquiring these financial instruments over mines, and then you put them effectively in your back pocket. You have them audited, when they're in production every so often. But you're out there looking for new acquisitions effectively thereafter. So it's a very scalable business. Our G&A it depends on how busy we are and how much we're paying lawyers and consultants in making acquisitions, but call it 3.5 to 4 million. And then debt service kind of depends again how much we've drawn on the revolver, but for this year, probably 2.5 to 3 million. Yeah, and we're kind of on track to deliver 11, 12 million in revenue for 2023. So royalty company financials are really hard to follow because we're obviously using amortization to drive down the tax bill. And we can offset the purchase price of a royalty against tax. So I always point people to cash flow, and on a cash flow basis, we're a cash flow positive company, and each incremental dollar as that revenue ticks up flows straight down to the bottom line. So you can see as these assets turn on, and particularly assets like Thacker Pass turn on and are fully de-risked at that point in time, that's a pretty clear time where we'd want to commence the dividend. And really our objective is to pull forward that date by acquiring more royalties.
Okay, we've got 30 seconds left. 2 questions. Where do you see yourself in 5 years' time?
I'd like to see the diversification built out more. I'd like to see nickel on here, uranium. I'd like to see the full spread of commodities such that investors can get exposure to Trident. By a single share of Trident, I've got, via the best type of financial instrument, I've got exposure to the entirety of the mining commodity sector. That would be the ideal outcome.
And David asks, very competitive business. Are you having to lower your bids on royalties to compete?
Well, in the current market, it's actually a great time for us to make acquisitions, which is why we made so many last year. We're not immune to the softness in share prices. Our share prices come off a bit here recently as well. That said, we're well funded, so we've seen the miners getting dinged even more aggressively. So they don't want to go out there and raise equity. they're open to royalty financing. Whereas in a more buoyant market, they tend to not like royalties because, as I said, they're there in perpetuity. They can't be bought back. They're a fixed instrument. So yeah, for us, it's a really good time to be deploying capital. And as I said, our new revolving credit facility actually lowers our cost of capital at a time where most operators' cost of capital are increasing due to inflation and interest rates. So we're really in a good position at the current moment.
Adam, thank you very much indeed. Really appreciate your time. And thank you, the audience, for some cracking questions.